Welcome to The Explainer. Today, we're unpacking a seriously fascinating economic analysis from financial analyst Jose Luis Cava. We're going to dive into three massive economic paradoxes defining our world right now. Think of it as a journey starting right in your own wallet, looking at household income, and then zooming all the way out to global power dynamics and the absolute reign of the US dollar. Trust me, the insights here are a total game changer.
So here's our roadmap for this explainer. First, the economic reality disconnect. Second, hard assets versus labor income. Third, the contrarian investing theory. Fourth, who really controls stimulus? And finally, number 5, global dollar dominance. Let's get right into it.
Section 1. The economic reality disconnect. This is all about the data versus sentiment. And honestly, it's a paradox almost everyone is feeling right now.
All right, let's look at this stark contrast. On paper, the U.S. economy is booming. Stocks are hitting record highs, unemployment is at rock bottom, and private consumption is just chugging along at a really healthy rate. But then we look at the reality on the ground. According to recent Gallup poll data, a massive 80% of Americans feel their personal economic situation is weak or at best just fair. Think about that. How is it mathematically possible that the economy is flying that high, but 8 out of 10 people feel like they're sinking?
To answer that, we move to Section 2, hard assets versus labor income. This explores the K-shaped economy and the deep divide in our modern financial landscape.
The core of this whole issue is something called a K-shaped recovery. Basically, this is a post-recession scenario where different parts of the economy recover at totally different rates. According to Cava's analysis, we aren't all living in the same economy anymore. In fact, he highlights a pretty mind-blowing statistic. The richest demographic in the US now accounts for nearly 60% of all private consumption. 60%! They're the ones driving that strong economic data we just talked about, while everyone else is kind of stuck sliding down the bottom leg of that K.
You can really see how the winners and losers separate in this K-shaped reality. On one side, you have the winners, people holding hard assets. We're talking the S&P 500, real estate, gold, Bitcoin, and high-level executives. Their wealth is shielded. But on the flip side, we have the losers, people relying strictly on labor income, an everyday salary or maybe small business revenue. Cava notes that young people often look for the safety of salaried jobs, like civil service roles in places like Spain, just looking for some security. But the crazy thing is, by doing that, they're walking right into the trap of inflation and monetary degradation. Their purchasing power is just silently, relentlessly eroding. They aren't feeling the economic progress because, well, their dollars literally buy less every single day.
Moving on to Section 3, the contrarian investing theory. Now that we understand that wealth divide, let's talk about market psychology.
Take a look at this number. 52%. According to a recent survey from Barron's magazine, 52% of professional fund managers are currently bullish on the stock market. They think it's a fantastic time to buy. And honestly, that is a huge jump in professional optimism compared to where we were just 6 months ago.
But here's the kicker. It's not just the crows. Data from the American Association of Individual Investors shows that retail investors, everyday people, are also super optimistic, coming in at 46% bullish. This officially snapped a 9-week streak where retail investors were mostly bearish. So we're seeing this really rare moment of totally synchronized optimism across the entire board.
Which brings us to a really crucial question. If absolutely everyone is already optimistic and everyone is already buying, who's actually left to buy? And that right there is the whole essence of the contrarian theory. The analysis points out that in the short term, when institutional optimism perfectly lines up with intense retail optimism, it's usually a massive red flag. This kind of extreme, widespread euphoria is very often the precursor to a short-term market correction. Because think about it, when there's literally no one left to convince, the market just runs out of fuel to keep going up.
That brings us to Section 4, who really controls stimulus, and more specifically, the Fed versus the Treasury.
So when that market correction inevitably hits, who's going to step in to stimulate the economy? Well, a recent Barron's cover story points out a huge misconception in how the media views stimulus. Everybody always assumes the Federal Reserve is the main engine, right? But while Kevin Warsh and the Fed might just lower interest rates and keep bank reserves ample to avoid market panic, the real heavy lifting happens at the U.S. Treasury, with Scott Bessent. The Treasury is currently sitting on a massive $1 trillion account at the Federal Reserve. Bessent is the guy who will actually deploy those funds to drive tangible economic stimulus, not the Fed.
And this whole dynamic leads to a very specific predicted sequence of events for the near future. Step 1, the Fed lowers interest rates later this year.
Step 2, the Fed keeps banking liquidity comfortable, basically acting as a shock absorber. Step 3, the U.S. Treasury actively deploys that $1 trillion war chest directly into the economy. And finally, Step 4, as a direct result of this massive liquidity injection from the Treasury, Kava's analysis projects the stock market will see a significant upward push late into the year and rolling right on into 2027.
All right, final section, number 5, the global dollar dominance. Let's look at its global reserve status.
We zoom out to the global stage here. We constantly hear these dramatic headlines about the death of the dollar. For instance, recently, the Iranian Revolutionary Guard claimed they'll soon negotiate their oil contracts in yuan, and by doing so, they'll single-handedly destroy the dollar's global dominance. Now, we're just neutrally reporting this claim as a perfect case study, because according to Kava's analysis, statements like this actually show a pretty profound misunderstanding of both global economics and financial history. Because financial history tells a way different story. Long before the oil boom of the 1970s, the eurodollar system was already firmly established over in London. And get this, here's the ultimate irony. During the Cold War, the Soviet Union actively supported and grew this offshore dollar system. Why? Because they wanted to hold dollars without the risk of them being confiscated by U.S. banks. So by the time the 1970s rolled around and petrodollars started flowing from the Gulf states, that offshore dollar infrastructure was already massive. Fast forward to today, and Gulf countries are actually actively borrowing in these European dollar markets. So we really need to clarify this vital distinction. Petrodollars are just a term for the flow of surplus dollars generated by oil-exporting Gulf countries. Eurodollars, on the other hand, are the actual structural foundation of offshore finance. We're talking about dollar operations and loans conducted completely outside the U.S. Kava points out that there's no magical secret agreement with the Gulf states keeping the dollar on top. The system is just far, far bigger than oil trades.
Ultimately, the dollar's true power comes down to three main things. Its dominance doesn't come from forcing countries to trade oil in dollars. It comes from the sheer, unmatched depth and liquidity of U.S. financial markets. Second, it comes from the overarching strength of the U.S. economy itself. And third, it relies on that incredibly massive, historically entrenched eurodollar infrastructure that's been humming along globally for over half a century.
Which really brings us full circle, right back to you and your wallet. We've looked at the hidden forces driving the market, the actual source of government stimulus, and the unshakable foundation of the global dollar. But the most pressing issue is still that initial disconnect we talked about. Inflation and monetary degradation are very real forces, quietly eating away at standard labor incomes every single day. So I want to leave you with a final, provocative thought to chew on. In a world of constant monetary degradation, are you positioned in hard assets, or are you just watching your purchasing power slowly fade away? Thanks for joining me on this explainer. Keep learning, keep questioning, and I'll see you next time.